Charlie Munger was born on January 1, 1924, in Omaha, Nebraska. When he entered the world, America was in the midst of the Roaring Twenties. The stock market had tripled since 1920. Real estate speculation was everywhere. Consumer credit had just been invented, with the idea that you could buy now and pay later. Price-to-earnings ratios were hitting records. Everyone seemed to be getting rich. The Great Depression was still 5 years away, and nobody saw it coming. This was the world of the Jazz Age. Prohibition was in full swing, with speakeasies and bootleggers operating openly. Flappers were challenging traditional values. Women had just gotten the vote in 1920. The radio was transforming communication, and automobiles were revolutionizing society. There were 15 million cars on American roads, compared to just 1 million in 1913. In the financial markets, speculation was seen as sophistication, not danger. Margin buying was standard practice. President Coolidge had famously said that the business of America is business. Investment trusts, the precursors to mutual funds, were proliferating. There were few regulations on securities. Insider trading was legal and common. This was the optimistic, overconfident world that Charlie Munger was born into. Omaha, Nebraska was a Midwest city of 200,000 people. It was an agricultural hub with conservative values. Presbyterian and Catholic influences ran deep. There was a small business district where the Munger and Buffett families would eventually work. Warren Buffett's father Howard was 21 years old when Charlie was born. Howard would marry 2 years later. The two families didn't know each other yet, but their paths would eventually cross in ways that would change the history of investing. Charlie would turn 5 years old in 1929 when the stock market crashed on Black Tuesday. He would turn 9 in 1933 at the Depression's depth, when unemployment hit 25% and banks were failing across the country. He would turn 17 in 1941 when Pearl Harbor was attacked. He would turn 21 in 1945 when World War II ended. His formative years were shaped by depression, war, and recovery. This crucible would shape everything about how he thought about risk, value, and resilience. The world Munger entered was optimistic and overconfident. But the world that formed him was one of sudden collapse and grinding hardship. This dissonance would make him permanently skeptical of consensus and euphoria. It would teach him to think independently, to question conventional wisdom, and to prepare for disasters that nobody else saw coming. Charlie's father, Alfred Case Munger, was a Harvard-educated lawyer who became a prominent attorney in Omaha. He was born in 1872 and practiced law well into his 80s. Alfred was known for his intellectual rigor, his integrity, and his independent thinking. He was not a man who followed the crowd or sought popularity. He valued competence over credentials, substance over style, and character over charm. Alfred's law practice was successful but not lavish. The Mungers were comfortable but not wealthy. They lived in a nice neighborhood but not the fanciest part of town. Alfred drove used cars and lived modestly. He believed in earning what you had and not spending beyond your means. These values would be transmitted directly to Charlie, who would adopt the same frugal lifestyle despite eventually becoming one of the wealthiest men in America. Alfred taught Charlie explicitly and implicitly. The explicit lessons came through conversations about law, business, ethics, and decision-making. Alfred would explain legal cases at the dinner table, walking through the arguments on both sides and the reasoning that led to the verdict. He taught Charlie to think clearly, to see both sides of an issue, and to distinguish between what was popular and what was right. The implicit lessons came through observation. Charlie watched his father work long hours, treat clients fairly, refuse cases he thought were wrong, and maintain his reputation above all else. Alfred turned down lucrative work if it conflicted with his values. He never cut corners or compromised his principles for money. This integrity made a deep impression on young Charlie. It taught him that reputation is irreplaceable and that how you make money matters as much as how much you make. Alfred was emotionally reserved, as many men of his generation were. He was not demonstrative with affection or praise. He expected excellence and didn't lavish compliments when it was achieved. This created in Charlie both a drive to prove himself and a lifelong discomfort with excessive praise or attention. Charlie learned to find satisfaction in the work itself, not in external validation. But Alfred was also present and engaged with his son's intellectual development. He encouraged Charlie's reading, answered his questions, challenged his thinking, and expected him to form independent judgments. The relationship was formal by modern standards but deeply influential. Charlie would later say that his father taught him the most important lesson of all, how to think. Charlie's mother, Florence Munger, came from a cultured family with strong intellectual interests. She was educated, well-read, and deeply involved in her children's upbringing. Florence emphasized education, reading, and intellectual curiosity. She made sure Charlie had access to books and encouraged him to read widely beyond his schoolwork. Florence created a stable, orderly home environment. The household ran on clear rules and expectations. Dinner was at the same time every day. Homework was completed before play. Church was attended every Sunday. This structure and consistency gave Charlie a foundation of discipline that would serve him throughout his life. She also softened some of Alfred's severity. While Alfred was demanding and exacting, Florence was more nurturing and encouraging. She celebrated Charlie's achievements and supported his interests. This balance between high expectations and emotional support helped Charlie develop both confidence and humility. He learned to push himself without becoming arrogant and to maintain standards without becoming rigid. Florence taught Charlie social graces and the importance of treating people with respect regardless of their status. She emphasized kindness, courtesy, and consideration for others. These lessons would shape how Charlie treated everyone from janitors to CEOs throughout his career. He never lost the basic decency his mother instilled in him. Charlie was the oldest of 3 children. He had 2 younger siblings, and birth order played a significant role in shaping his personality. As the firstborn, he felt a sense of responsibility and set an example for his younger brother and sister. He was expected to be mature, capable, and self-sufficient. This created a lifelong pattern of self-reliance and taking charge of situations. The Munger family was upper middle class but not wealthy. They lived comfortably but without extravagance. Charlie attended public schools in Omaha, not private academies. He saw both prosperity and hardship in his community, especially during the Depression years. This gave him a realistic understanding of money and its role in life. He learned that financial security was important but that character and capability mattered more. Charlie experienced the Depression as a child and teenager. He saw successful businessmen lose everything. He saw banks fail and savings disappear. He saw unemployment and breadlines and foreclosures. These experiences taught him about the fragility of prosperity and the importance of preparation. They made him skeptical of leverage, cautious about risk, and focused on building resilience into everything he did. The Depression also showed Charlie how some people thrived while others failed during the same crisis. He noticed that certain businesses survived and even prospered while others collapsed. He began to think about what made the difference. Why did some companies have staying power while others didn't? Why did some people emerge stronger while others were destroyed? These questions would become central to his investment philosophy decades later. Charlie's introduction to business came early and came naturally. His grandfather Ernest Buffett owned a grocery store in Omaha where both Charlie and Warren Buffett would eventually work, though at different times. The store was called Buffett & Son, and it was a neighborhood institution. Charlie worked there as a young teenager, stocking shelves, helping customers, and learning the basics of retail. Working in the grocery store taught Charlie about margins, inventory, customer service, and the hard work of running a small business. He saw how thin the profit margins were and how much effort went into earning each dollar. He learned that business success required constant attention to detail, fair dealing with customers, and careful management of costs. These lessons stuck with him. Charlie also learned about human nature at the grocery store. He saw which customers were reliable and which weren't. He saw how people made buying decisions, what they valued, and what they complained about. He learned that trust and reputation were the foundation of any business relationship. If customers trusted you, they came back. If they didn't, they went elsewhere. This simple truth would guide his business dealings for the next 80 years. As a child, Charlie was intellectually curious but not particularly social. He was more interested in books and ideas than in sports or social activities. He read voraciously, consuming everything from science to history to biography. His parents encouraged this, and the house was full of books. Charlie would spend hours in his room reading, thinking, and teaching himself about subjects that interested him. Charlie's personality showed itself early. He was analytical and logical. He liked to understand how things worked and why they worked that way. He was not content with surface explanations. He wanted to know the underlying mechanisms, the causal chains, the first principles. This drive to understand things deeply would become the foundation of his investing approach. He was also stubborn and independent-minded. Once Charlie formed an opinion based on reasoning and evidence, he didn't change it just because others disagreed. He was willing to be wrong, but he needed to be convinced by logic and facts, not by consensus or authority. This contrarian streak would serve him well as an investor, where the crowd is usually wrong at extremes. Charlie had a sharp tongue and little patience for foolishness. Even as a young man, he could be blunt and direct to the point of rudeness. He didn't suffer fools gladly and didn't hide his contempt for sloppy thinking or lazy reasoning. This made him respected but not always liked. It also meant he attracted people who valued substance over style and who could handle direct feedback without taking it personally. One formative event in Charlie's childhood was his early exposure to mathematics and scientific thinking. He excelled at math in school and loved the certainty and logic of it. Math taught him that there were right answers and wrong answers, and that careful reasoning could distinguish between them. This gave him confidence in his own analytical abilities and a framework for approaching problems systematically. Charlie also developed an early interest in how things were built and how systems worked. He took apart mechanical devices to understand them. He asked endless questions about how businesses operated, how laws were made, how organizations functioned. He wanted to see beneath the surface to the mechanisms that drove outcomes. This systems thinking would become central to his investment philosophy. By the time Charlie was a teenager, several patterns were clear. He was intellectually gifted but not interested in showing off. He was independent-minded to the point of stubbornness. He valued competence and integrity above all else. He was deeply analytical and systematic in his thinking. He was frugal and practical. And he was already thinking about how the world worked in ways that most teenagers never considered. Charlie attended Central High School in Omaha, a public school known for academic rigor. He was a strong student but not obsessed with grades. He cared more about learning than about academic achievement for its own sake. He took challenging courses in mathematics, science, and literature. He continued to read widely outside of school, often far beyond what was assigned. At Central High, Charlie encountered teachers who recognized his abilities and challenged him intellectually. One mathematics teacher in particular pushed him to think more deeply about proofs and problem solving. Charlie later credited this teacher with teaching him the importance of working from first principles and not accepting conclusions without understanding the reasoning behind them. Charlie was not particularly interested in the social aspects of high school. He didn't go to many dances or football games. He had a small circle of intellectually curious friends with whom he discussed ideas and argued about everything from politics to philosophy. These debates sharpened his thinking and taught him how to construct and defend arguments. During high school, Charlie began to think seriously about his future. His father expected him to become a lawyer, and Charlie initially accepted this path. Law seemed like a good fit for his analytical mind and his interest in reasoning and argument. But Charlie was also beginning to develop an interest in business and investing, though he didn't yet see it as a potential career. In 1941, when Charlie was 17, he graduated from high school and enrolled at the University of Michigan to study mathematics. This was wartime America. The attack on Pearl Harbor happened in December of 1941, just months after Charlie started college. the war would reshape his college experience and his early adult life. Charlie studied mathematics at Michigan for 2 years, from 1941 to 1943. He excelled in his coursework and loved the rigor and logic of advanced mathematics. He studied calculus, statistics, and mathematical logic. These subjects trained his mind to think precisely, to work from axioms to conclusions, and to distinguish between valid and invalid reasoning. But the war interrupted his education. In 1943, at age 19, Charlie joined the Army Air Corps. He was sent to the California Institute of Technology, Caltech, for training in meteorology. This was a critical skill for military aviation, and the Army needed educated young men who could master the complex mathematics and physics involved in weather prediction. Charlie's time at Caltech was transformative. He studied under some of the best scientists in the world. He learned thermodynamics, fluid dynamics, and atmospheric physics. He worked with sophisticated mathematical models and learned to make predictions based on incomplete information. This experience taught him several lessons that would later shape his investing philosophy. First, Charlie learned that the world is complex and that simple models often fail. Weather prediction required understanding how multiple systems interacted in non-linear ways. Small changes in initial conditions could lead to dramatically different outcomes. This taught Charlie humility about prediction and the limits of human knowledge. It made him skeptical of anyone who claimed to know the future with certainty. Second, Charlie learned the value of checklists and systematic processes. Meteorology required following precise procedures to collect data, analyze it, and make forecasts. Cutting corners or skipping steps led to errors. This instilled in Charlie a respect for process and discipline that would later show up in his investment decision-making. Third, Charlie was exposed to some of the greatest scientific minds of his generation at Caltech. He saw how they thought, how they approached problems, how they collaborated and debated. He learned that genius wasn't about having all the answers. It was about asking the right questions, gathering relevant data, reasoning carefully, and being willing to change your mind when evidence contradicted your beliefs. Charlie never saw combat, but his military service shaped him. It taught him discipline, teamwork, and how to function under pressure. It exposed him to people from different backgrounds and regions. It gave him confidence in his abilities and showed him that he could handle difficult challenges. And it gave him a network of relationships that would later prove valuable. After his military service ended in 1946, Charlie returned to civilian life. He was 21 years old. He had served his country, received an extraordinary education in mathematics and physics, and now needed to decide what to do with his life. His father still expected him to become a lawyer, and Charlie decided to pursue that path. But there was a problem. Charlie had not completed his undergraduate degree. He had only 2 years at Michigan before joining the military. Normally, law schools required a bachelor's degree for admission. But Charlie's performance at Caltech and his military service impressed the admissions committee at Harvard Law School. They admitted him without an undergraduate degree, a rare exception that speaks to his obvious capabilities. Charlie entered Harvard Law School in 1947 at age 23. He would spend the next 3 years studying law, but more importantly, learning how to think like a lawyer. Harvard used the case method, where students read actual legal cases and analyzed the reasoning of judges. This trained Charlie to see both sides of any argument, to identify the key issues, to distinguish between strong and weak reasoning, and to construct logical arguments. Charlie excelled at Harvard. He graduated magna cum laude in 1948, finishing in the top of his class. But more important than his grades was what he learned about reasoning, persuasion, and decision-making. Law school taught him to break down complex problems into component parts, to identify the critical facts, to apply relevant principles, and to reach sound conclusions. These skills would prove invaluable in investing. During his time at Harvard, Charlie also began to think more seriously about business and wealth building. Many of his classmates came from wealthy families and talked about family businesses, investments, and financial strategies. Charlie realized that while law was a respectable profession, it was not the path to significant wealth. Lawyers traded time for money. To become truly wealthy, you needed to own assets that appreciated or businesses that generated income without your constant involvement. This insight was forming but not yet fully developed. Charlie still planned to practice law after graduation. But the seed was planted. He began to read about business and investing in his spare time. He studied annual reports of companies. He read about successful businessmen and investors. He was developing a framework for understanding how wealth was created and preserved. Charlie also married during this period. In 1945, shortly after returning from military service, he married Nancy Huggins. They had met in Southern California during the war. Nancy came from a good family and shared Charlie's Midwestern values of hard work, frugality, and integrity. They would have 3 children together over the next several years. After graduating from Harvard Law School in 1948, Charlie faced a choice about where to practice law. His father expected him to return to Omaha and eventually join the family law practice. But Charlie was drawn to California. He had fallen in love with the climate and the opportunities of the West Coast during his time at Caltech and his military service. California in the late 1940s was booming. The post-war economy was creating enormous opportunities, especially in Southern California. Charlie made a fateful decision. He told his father he was moving to California to start his own law practice. This was not what Alfred Munger wanted to hear. He was disappointed and felt Charlie was making a mistake. But Charlie was independent-minded and determined. He moved his young family to Southern California in 1948 and set about building a law practice from scratch. Charlie joined the law firm Wright & Garrett in Pasadena. He started at the bottom, working long hours on whatever cases the partners gave him. He did research, drafted documents, and slowly built his skills as a practicing attorney. The work was demanding but not particularly interesting to Charlie. He found much of legal practice to be routine and bureaucratic. But he was good at it, and his analytical skills made him effective. What interested Charlie more than the law itself was the business problems his clients faced. When he worked on corporate cases, he would dig deep into understanding the client's business, their industry, their competitors, and their strategic challenges. He realized he was more interested in solving business problems than legal problems. Law was just a tool. Business was the game. During his early years in California, Charlie began to invest in real estate on the side. This was his first serious venture into building wealth beyond his legal salary. He would identify undervalued properties, often small apartment buildings, buy them with borrowed money, improve them, and either hold them for rental income or sell them at a profit. This hands-on experience taught him about leverage, about property values, about management, and about the power of buying assets below their intrinsic value. Charlie's real estate investments were successful. He was making more money from his part-time investing than from his full-time law practice. This reinforced his growing belief that the path to wealth was not through professional services but through ownership of assets. He began to think more seriously about transitioning from law to investing. But life dealt Charlie a devastating blow in the early 1950s. His marriage to Nancy deteriorated and ended in divorce. This was personally and financially crushing. Divorce was uncommon in that era and carried significant social stigma. Charlie had to split assets with Nancy and pay substantial alimony and child support. The divorce left him nearly broke and emotionally devastated. Even worse, one of his children from the marriage, a young son named Teddy, was diagnosed with leukemia. In the 1950s, childhood leukemia was essentially a death sentence. There was no effective treatment. Charlie watched his son suffer and slowly die, unable to do anything to help him. Teddy died in 1955 at age 9. The loss was unbearable. Charlie later described this period as the darkest of his life. He was working punishing hours to rebuild his finances after the divorce. He was grieving the loss of his son. He was questioning everything about his life and his choices. Many men would have been destroyed by this combination of professional, financial, and personal catastrophe. But Charlie found a way through it. He threw himself into his work. He focused on what he could control. He maintained relationships with his surviving children despite the challenges of the divorce. He slowly rebuilt his financial position through continued real estate investments and his law practice. And he met someone who would change his life. In 1956, Charlie met Nancy Barry. She was significantly younger than Charlie, but they connected immediately. Nancy Barry was intelligent, stable, and emotionally supportive in a way Charlie desperately needed. They married in 1956, and Nancy helped Charlie heal from the traumas of the previous years. They would have 4 more children together and build a long, stable, happy marriage that lasted until Charlie's death. Nancy Barry Munger provided Charlie with emotional stability and a true partnership. She managed their household and raised their large combined family while Charlie focused on his career. She was frugal and practical, sharing Charlie's values about money and life. She didn't need or want lavish displays of wealth. She was content with a comfortable but not ostentatious lifestyle. This alignment of values was crucial to their successful marriage. With his personal life stabilized, Charlie was able to refocus on his professional life. He was still practicing law and making decent money. He was still investing in real estate and doing well. But he was increasingly drawn to stock market investing. He had been reading about Benjamin Graham and value investing. He had been studying annual reports and learning how to analyze businesses. He was beginning to develop his own investment philosophy. The pivotal moment came in 1959. Charlie was 34 years old, a successful attorney with a growing real estate portfolio and a stable family life. And then he had a conversation that would change everything. That conversation was with Warren Buffett, and it happened at a dinner party in Omaha. The introduction was arranged by a mutual friend who thought the 2 men should meet. Both were from Omaha. Both had worked at the same grocery store owned by Warren's grandfather, though at different times. Both were intellectually curious and loved business and investing. The friend was right. Charlie and Warren hit it off immediately. The conversation lasted hours. They talked about businesses, about investments, about decision-making, about human nature. Warren could tell immediately that Charlie was different. He had a razor-sharp mind, a multidisciplinary approach to thinking, and a willingness to challenge assumptions that Warren found refreshing. Charlie could tell that Warren had an extraordinary gift for analyzing businesses and an encyclopedic knowledge of companies and industries. Warren was already running an investment partnership in Omaha and doing extraordinarily well. He had learned value investing from Benjamin Graham at Columbia and was applying Graham's principles with remarkable success. He was buying undervalued stocks, often in obscure companies, and generating returns that far exceeded market averages. He was 28 years old and already managing over $1 million. Charlie was intrigued. He had been thinking about making a transition from law to investing, but he wasn't sure how to do it. Warren showed him a path. Warren explained his investment approach, his partnership structure, how he found opportunities, how he analyzed them, and how he made decisions. Charlie was impressed by the systematic nature of Warren's approach and by his track record. Warren encouraged Charlie to start his own investment partnership. He said Charlie had the right temperament and skills to be an excellent investor. He offered to help Charlie get started and to share ideas. This conversation planted the seed that would eventually grow into one of the most successful intellectual partnerships in investment history. But Charlie didn't immediately jump into full-time investing. He continued practicing law for several more years while gradually building an investment track record on the side. In 1962, Charlie finally launched his own investment partnership, Munger Wheeler and Company. He was 37 years old. He would continue practicing law part-time until 1965, when he finally left the legal profession entirely to focus on investing. Charlie's approach to investing was influenced by Benjamin Graham's value investing principles, which he learned about from Warren. But Charlie would eventually evolve beyond Graham in important ways. Graham focused on buying stocks that traded for less than their liquidation value, often called cigar butt investing. The idea was to buy stocks so cheap that even if the business was mediocre, you would make money. Charlie initially followed this approach and did well with it. But he began to see its limitations. First, truly cheap stocks in Graham's sense were becoming harder to find as markets became more efficient. Second, buying terrible businesses even at cheap prices meant you often got stuck with terrible businesses. They rarely improved and often deteriorated. Third, this approach didn't take advantage of compounding in truly great businesses. Charlie began to develop a different framework. He started thinking about the quality of the business, not just the price of the stock. He asked whether a company had durable competitive advantages, strong management, and the ability to compound earnings over long periods. He was willing to pay a fair price for a wonderful business rather than a wonderful price for a fair business. This insight would eventually transform Warren Buffett's investing approach as well. Charlie's investment partnership ran from 1962 to 1975. Over those 13 years, Charlie compounded capital at approximately 20% annually, compared to about 5% for the Dow Jones Industrial Average. This was an extraordinary track record, especially considering that Charlie was essentially a one-man operation without the resources of a large investment firm. But the path was not smooth. Charlie experienced significant volatility in his partnership returns. Some years he was up 40 or 50%. Other years he was down significantly. In 1973 and 1974, during a severe bear market, Charlie's partnership dropped substantially. This volatility was uncomfortable for limited partners who were not accustomed to such swings. Charlie learned important lessons during this period. He learned that generating high returns required accepting significant volatility. He learned that the market could be irrational for long periods, and you needed emotional fortitude to stick with your positions when they were temporarily underwater. He learned that many investors said they wanted high returns but couldn't psychologically handle the volatility required to achieve them. These experiences reinforced Charlie's belief in the importance of temperament in investing. Intelligence was necessary but not sufficient. You also needed the ability to remain calm during periods of market panic, to think independently when everyone else was convinced you were wrong, and to maintain conviction in your analysis even when the stock price suggested you were mistaken. During the 1960s and early 1970s, Charlie and Warren were in frequent contact. They would talk on the phone regularly, discussing investment ideas, analyzing businesses, and thinking through strategic questions. Warren was running his investment partnership in Omaha with great success. Charlie was running his partnership in California with similar success. They were operating independently but learning from each other constantly. Their intellectual collaboration was extraordinarily productive. Each brought different strengths. Warren had an encyclopedic knowledge of businesses and could analyze financial statements instantly in his head. He could calculate intrinsic value rapidly and had superb recall of historical business performance. Charlie brought a multidisciplinary framework that incorporated psychology, economics, mathematics, and philosophy. He pushed Warren to think more broadly and to consider factors beyond just the numbers. Charlie also pushed Warren to evolve beyond strict Graham-style cigar butt investing. He argued that buying wonderful businesses at fair prices was better than buying fair businesses at wonderful prices. The logic was simple. Wonderful businesses could be held for decades and would compound in value as the business grew. Fair businesses rarely improved and often required constant monitoring and eventual sale. This insight had profound implications. It meant you should focus on a smaller number of truly great businesses rather than a large portfolio of mediocre ones. It meant you should be willing to pay up for quality rather than only buying extreme bargains. It meant you should think about holding period in decades rather than years. And it meant you should focus on businesses with durable competitive advantages rather than statistical cheapness. Warren was initially skeptical of this approach. He had been trained by Graham to focus on price above all else. Graham's famous saying was that price is what you pay and value is what you get. Graham taught that a margin of safety came from buying assets for significantly less than their intrinsic value. This approach had worked brilliantly for Graham and was working well for Warren. But Charlie persisted in his arguments. He used examples to make his point. He showed Warren businesses like See's Candies, which they would eventually buy together. See's had strong brand loyalty, pricing power, high returns on capital, and required little capital to grow. It wasn't statistically cheap by Graham's standards, but it was a wonderful business that could compound value for decades. Charlie argued this was a better investment than a statistically cheap textile mill that was slowly declining. The turning point came with their joint acquisition of See's Candies in 1972. Berkshire Hathaway, which Warren controlled, and Blue Chip Stamps, which Charlie helped manage, jointly bought See's for $25 million. This was about 5 times book value and seemed expensive by Graham standards. Graham would likely have passed on the deal as too pricey. But Charlie saw it differently. See's had a beloved brand in California. Customers were willing to pay premium prices for See's candy during holidays. The business generated cash that could be redeployed into other investments. It required little capital to maintain and grow. And most importantly, it had pricing power. See's could raise prices ahead of inflation without losing customers. This pricing power meant the business would compound in value over time. The See's investment was transformative for both Charlie and Warren. It proved Charlie's thesis about quality businesses. Over the next 50 years, See's would generate over $2 billion in pre-tax earnings for Berkshire while requiring minimal capital investment. The $25 million investment returned 80 times, not from selling the business but from the cumulative cash it generated over decades. This success caused Warren to fundamentally rethink his investment approach. He began to focus more on business quality and less on statistical cheapness. He started to think about holding periods in decades rather than years. He became willing to pay fair prices for wonderful businesses rather than only buying extreme bargains. Charlie's influence had reshaped Warren's investment philosophy in profound ways. But Charlie's secret source of investing success wasn't just this insight about quality versus cheapness. It was deeper than that. Charlie had developed a unique mental framework that he called a latticework of mental models. This framework drew on ideas from multiple disciplines including psychology, economics, mathematics, physics, biology, and history. Charlie believed that to understand business and investing, you needed to think across disciplines. From psychology, Charlie took insights about human behavior, cognitive biases, and decision-making under uncertainty. He understood that humans are not rational actors as economists assumed. We make systematic errors in judgment. We fall prey to confirmation bias, anchoring effects, social proof, and authority bias. Understanding these biases helped Charlie avoid common investing mistakes and recognize when markets were being driven by psychological factors rather than fundamental reality. From economics, Charlie took insights about incentives, opportunity costs, and competitive dynamics. He understood that people respond to incentives and that if you want to predict behavior, you need to understand what people's incentives are. He understood that every decision involves trade-offs and opportunity costs. He understood that competitive advantages erode over time unless they are protected by barriers to entry. From mathematics, Charlie took insights about probability, compound interest, and statistical thinking. He understood that investing was fundamentally about making probabilistic judgments under conditions of uncertainty. He understood the extraordinary power of compounding over long time periods. He understood that you needed to think in terms of expected values, not just possible outcomes. From physics and engineering, Charlie took insights about feedback loops, critical mass, and breakpoints. He understood that small inputs could create large outputs when systems reached critical thresholds. He understood that positive feedback loops could create exponential growth or decay. He understood that systems under stress often failed at weak points. From biology, Charlie took insights about evolution, adaptation, and ecosystems. He understood that businesses evolved over time through selection pressures. He understood that survival required adaptation to changing conditions. He understood that businesses existed in ecosystems where they competed and cooperated with other entities. From history, Charlie took insights about patterns that repeated across time and cultures. He understood that human nature doesn't change and that the same dynamics play out repeatedly. He understood that studying history helped you recognize patterns and avoid repeating past mistakes. He was a voracious reader of biography and history and constantly drew lessons from the past. Charlie synthesized these insights from different disciplines into a unified framework for thinking about business and investing. He would approach an investment opportunity by asking questions from multiple perspectives. What are the psychological biases that might be affecting how people value this business? What are the economic incentives facing management, and how will those drive behavior? What is the probability distribution of possible outcomes? What are the critical feedback loops in this business model? How has this company adapted to changing conditions in the past? What does history teach us about similar situations? This multidisciplinary approach gave Charlie an edge over investors who relied solely on financial analysis. He could see dimensions of an opportunity that others missed. He could identify risks that weren't apparent in the numbers. He could recognize patterns that predicted future behavior. And he could make judgments about management quality and business durability that went beyond quantitative metrics. Charlie was also extraordinarily disciplined about his circle of competence. He knew what he understood and what he didn't. He stayed within areas where he had genuine expertise and insight. He was willing to pass on opportunities that fell outside his circle of competence, even if they looked attractive on the surface. This discipline helped him avoid mistakes that came from overconfidence and venturing into unfamiliar territory. Another secret source of Charlie's success was his temperament. He had the ability to remain calm and rational during periods of market panic when others were losing their heads. He didn't get caught up in the euphoria of bubbles or the despair of crashes. He maintained emotional equilibrium through extreme volatility. This allowed him to buy when others were panicking and sell when others were euphoric. Charlie's temperament was partly innate but also deliberately cultivated. He had systems and processes that helped him maintain discipline. He used checklists to ensure he didn't skip important steps in his analysis. He forced himself to write down his investment thesis before making a commitment so he could review it later. He sought out people who would challenge his thinking and tell him when he was wrong. He accepted that he would make mistakes and tried to learn from them rather than denying them. Charlie also had extraordinary patience. He was willing to wait years for the right opportunity. He didn't feel pressure to be constantly active. He understood that in investing, activity is often the enemy of returns. The best strategy is often to do nothing and wait for a fat pitch. Charlie could sit on cash for months or years until he found an opportunity that met his high standards. This patience was reinforced by his partnership structure. Charlie's limited partners were friends and family members who trusted him completely. They didn't panic during down periods or demand constant activity. This allowed Charlie to operate with a very long time horizon and to make decisions based on what was right rather than what would satisfy impatient investors. Charlie's relationship with Warren Buffett was itself a source of competitive advantage. The two men made each other smarter. Warren would catch errors in Charlie's reasoning and vice versa. They would debate investment ideas and stress test each other's logic. They would share information and insights that gave both of them advantages. This intellectual partnership created value that neither could have achieved alone. But the relationship worked because of mutual respect and complementary blind spots. Warren was better at financial analysis and valuation. Charlie was better at seeing the qualitative factors that numbers couldn't capture. Warren was more optimistic by nature. Charlie was more skeptical and would point out what could go wrong. Warren was a better communicator and teacher. Charlie was a better systems thinker and strategist. Together they covered each other's weaknesses. During the 1970s, Charlie and Warren's lives and businesses became increasingly intertwined. Warren had closed his investment partnership in 1969 and was focusing on running Berkshire Hathaway, a struggling textile company he had taken control of in the 1960s. Charlie was still running his investment partnership but was also involved in several businesses including Blue Chip Stamps, a trading stamp company that both he and Warren controlled. Blue Chip Stamps was interesting because it generated float. Customers would buy stamps from retailers and eventually redeem them for merchandise. But there was always a lag between when the money was received and when it had to be paid out. This lag created float that could be invested. It was like an interest-free loan that could be used to compound wealth. Both Charlie and Warren recognized the value of this float and worked to deploy it intelligently. Through blue chip stamps, Charlie and Warren made several significant investments together during the 1970s. In addition to See's Candies in 1972, they bought the Buffalo Evening News in 1977 and Wesco Financial in 1973. Each of these investments taught them lessons about business quality, competitive advantages, and value creation. The Buffalo Evening News investment was particularly challenging. They paid $32 million for the newspaper, which seemed like a good price. The paper had a monopoly in Buffalo and should have generated strong returns. But shortly after they bought it, the paper faced a brutal price war with a competing paper. The competition drove both papers into the red. The investment looked like it might be a disaster. But Charlie and Warren stuck with it. They invested more capital to see the paper through the crisis. They supported management's decision to fight for market dominance rather than surrendering share to maintain short-term profitability. Eventually, the competing paper folded, and the Buffalo Evening News became highly profitable as the sole newspaper in the market. The investment worked out brilliantly, but it required patience and deep pockets to survive the crisis. This experience reinforced several lessons. First, competitive dynamics mattered enormously. Even a good business could struggle if competitors were irrational. Second, you needed financial staying power to outlast competitors who were willing to lose money. Third, management quality was critical. You needed leaders who would make the right strategic decisions even when they were painful in the short term. Fourth, you needed the temperament to stick with an investment through temporary setbacks if the long-term logic remained sound. The Wesco Financial investment started as a potential acquisition target but ended up as a long-term holding. Wesco was a savings and loan company that owned a valuable insurance subsidiary. Charlie saw it as a source of insurance float that could be invested for long-term gains. Berkshire acquired control of Wesco, and Charlie became its chairman. He would run Wesco for the next 30-plus years, using it as a vehicle for making investments alongside Berkshire. By the mid-1970s, Charlie had made a key decision about his future. He closed his investment partnership in 1975 and joined forces with Warren more formally. Charlie became vice chairman of Berkshire Hathaway and Warren's closest partner in running the company. This partnership would last for nearly 50 years until Charlie's death in 2023. The decision to partner with Warren full-time was significant for Charlie. It meant giving up his independence as a solo investor. It meant subordinating his ego to Warren since Warren was clearly the lead partner and public face of Berkshire. It meant moving from California to spending more time in Omaha. But Charlie recognized that the partnership with Warren was more valuable than solo success. Together they could accomplish more than either could alone. What made Charlie different from other investors was not just his intelligence or his analytical skills. Many investors were smart and analytical. What made Charlie unique was his combination of qualities that rarely exist together. He had deep analytical rigor combined with broad multidisciplinary thinking. He had strong conviction combined with intellectual humility. He had patience combined with decisiveness. He had independence combined with collaboration. And he had financial success combined with lack of ego. Charlie's lack of ego was particularly unusual. Despite being one of the most successful investors in history, he never sought the spotlight. He was content to be Warren's partner rather than needing to be the star. He didn't write books promoting his investment philosophy. He didn't start a hedge fund to gather assets and fees. He didn't go on television to share his opinions. He just did the work, compounded capital, and lived quietly. This lack of ego served him well. It allowed him to learn from others without defensiveness. It allowed him to admit mistakes without rationalizing them. It allowed him to change his mind when evidence contradicted his beliefs. It allowed him to collaborate effectively without needing to dominate. And it allowed him to maintain perspective about what really mattered in life, which was not money or fame but intellectual growth, meaningful relationships, and contributing value. Charlie's philosophy of life was intertwined with his philosophy of investing. Both were built on a few key principles. First, play the long game. Don't optimize for short-term gains at the expense of long-term success. Second, operate within your circle of competence. Know what you know and what you don't. Third, be patient and wait for the right opportunities. Fourth, think probabilistically and accept that you'll be wrong sometimes. Fifth, learn constantly from multiple disciplines. Sixth, maintain high ethical standards. Seventh, work with people you trust and enjoy. Eighth, live below your means. Ninth, compound slowly and steadily over decades. These principles guided Charlie through the second half of his career from 1975 until his death in 2023. During this nearly 50-year period, Charlie and Warren built Berkshire Hathaway into one of the most valuable companies in the world. The stock price went from under $20 per share in the early 70s to over $500,000 per share by Charlie's death. That represents a compound annual return of roughly 20% over 5 decades. But the story of how they did it is not just about picking stocks. It's about building an organization, creating a culture, developing operating principles, and making strategic decisions about capital allocation. Charlie's influence was central to all of this. While Warren was the public face of Berkshire, Charlie was the strategic thinker who helped shape the major decisions. One of the most important strategic insights that Charlie brought to Berkshire was the shift from buying statistically cheap stocks to buying whole businesses. In the early years, Berkshire made money primarily by buying undervalued stocks and selling them when they reached fair value. This worked but had limitations. You paid taxes on gains when you sold. You lost the opportunity to compound those gains in great businesses. And you constantly needed to find new ideas to replace positions you sold. Charlie argued for a different approach. Buy entire businesses with durable competitive advantages, excellent management, and the ability to compound earnings over long periods. Don't sell them. Let the earnings compound tax-free within Berkshire. Reinvest those earnings in additional businesses or stocks. Over decades, the compounding would create extraordinary wealth. This strategy required buying businesses rather than just stocks. It required evaluating management since you'd be working with them long term. It required thinking about business culture and value since you'd be owning these operations forever. It required willingness to let managers run their businesses without interference while maintaining high standards. And it required patience to let the compounding work over decades. Berkshire's acquisition of Cease Candies in 1972 was an early example of this strategy. The next major example was the insurance businesses that became the core of Berkshire's operations. Charlie and Warren realized that insurance companies generated float from premiums that came in before claims had to be paid out. If you could invest that float intelligently and maintain underwriting discipline to avoid losses, the float was essentially free capital that could compound over time. Berkshire acquired National Indemnity in 1967, before Charlie formally joined. But over the next decades, Charlie and Warren built out Berkshire's insurance operations through a series of acquisitions. They bought Geico, one of the largest auto insurers in America, in 1996. They built a reinsurance operation that became one of the largest in the world. By the 2000s, Berkshire had nearly $100 billion in float that it could invest. This float was the key to Berkshire's success. It gave Charlie and Warren permanent capital that never had to be returned to investors. It gave them flexibility to make opportunistic investments when others were constrained. It gave them patience to hold investments for decades without pressure to sell. And it gave them scale advantages that smaller investors couldn't match. Charlie was instrumental in recognizing the strategic value of insurance float and in building out Berkshire's insurance operations. He understood that insurance was not just a business but a platform for compounding capital. He helped develop the operating principles that made Berkshire's insurance businesses successful. And he helped recruit and retain the exceptional managers who ran those businesses. Another major strategic insight that Charlie brought was the importance of incentives and culture. He argued that the structure of an organization determined its outcomes more than people realized. If you had the right incentives and culture, good things would happen naturally. If you had misaligned incentives or a dysfunctional culture, even talented people would produce poor results. Berkshire's organizational structure reflected Charlie's insights. The corporate headquarters was tiny, with fewer than 30 people managing a company worth hundreds of billions of dollars. Operating businesses were run by their managers with minimal interference from corporate. Compensation was based on the specific metrics that mattered for each business, not on overall corporate performance. Managers were given autonomy but held accountable for results. Capital allocation decisions were centralized with Charlie and Warren. This structure minimized bureaucracy, avoided corporate politics, empowered good managers, and kept costs low. It also attracted exceptional managers who valued autonomy and wanted to build something lasting. Many of Berkshire's operating company CEOs could have made more money elsewhere. They stayed because they loved the culture and the freedom to run their businesses the way they thought best. Charlie's influence on culture went beyond structure. He and Warren established principles that guided behavior throughout Berkshire. They emphasized integrity above all else. They insisted on transparency with shareholders. They avoided leverage and financial engineering. They never made hostile acquisitions. They kept their word even when legally they didn't have to. They treated employees, customers, and partners fairly. And they maintained high standards for themselves and expected the same from everyone in the organization. This culture became Berkshire's greatest competitive advantage. It attracted the best managers, the best acquisition opportunities, and the most loyal shareholders. Other companies had capital and intelligence. What they didn't have was Berkshire's reputation and culture, built over decades by Charlie and Warren's consistent behavior. Throughout the 1980s and 1990s, Berkshire grew through a combination of successful investments in publicly traded stocks and acquisitions of private businesses. Some of the major public stock investments during this period included Coca-Cola, American Express, Gillette, and Wells Fargo. Some of the major business acquisitions included Scott Fetzer in 1986, Borsheim's Jewelry in 1989, and Flight Safety International in 1996. Each of these investments illustrated the principles Charlie and Warren had developed. Look for businesses with durable competitive advantages. Focus on management quality and integrity. Be willing to hold forever if the business continues performing. Don't overpay, but recognize that a fair price for a wonderful business is better than a wonderful price for a fair business. Operate with a decades-long time horizon. The Coca-Cola investment in 1988 was particularly significant. Warren invested over $1 billion in Coca-Cola stock, eventually accumulating 7% of the company. This was Berkshire's largest position and represented a major bet on a single company. Many investors thought Warren was overpaying. Coca-Cola was trading at a premium valuation by historical standards. But Charlie and Warren saw something others missed. Coca-Cola had the strongest brand in the world. It had unmatched distribution reaching nearly every corner of the globe. It had pricing power, allowing it to raise prices ahead of inflation. It had excellent management under Roberto Goizueta. And it was benefiting from globalization as developing countries increased their consumption of branded consumer goods. The business could compound for decades. Charlie supported this concentrated bet despite the risks. He understood that when you find a truly exceptional business at a reasonable price, you should bet big. Diversification is protection against ignorance. If you know what you're doing, concentrated positions in your best ideas make sense. The Coca-Cola investment would grow to be worth over $20 billion over the next decades, one of the most successful investments in Berkshire's history. The Wells Fargo investment in 1990 was even more concentrated and controversial. Charlie and Warren invested nearly $500 million in Wells Fargo, making it Berkshire's largest position. This was during a banking crisis when many banks were failing and the entire sector was under suspicion. Most investors were avoiding bank stocks. Charlie and Warren were buying aggressively. Their reasoning was based on careful analysis of Wells Fargo's business model, management quality, and balance sheet strength. Wells Fargo had the best cost structure in the industry, the best management team, and strong capital ratios. It was trading at a significant discount to intrinsic value due to fear in the market. If Wells Fargo survived the crisis, which Charlie and Warren believed it would, the investment would generate exceptional returns. Charlie's role in this decision was critical. He helped Warren analyze the risks and determine that they were acceptable. He provided perspective from his multidisciplinary framework about how banking crises typically unfolded and what separated survivors from casualties. He reinforced Warren's conviction when the position went underwater in the short term. And he helped evaluate when to add to the position versus when to be patient. The Wells Fargo investment ultimately worked out brilliantly. The bank survived and thrived. The stock price recovered and continued climbing for years. Berkshire made billions of dollars on the investment. But it required staying calm during a crisis, thinking independently when the consensus was negative, and having the courage to make a concentrated bet when the odds were in your favor. These episodes illustrate Charlie's value to Warren and to Berkshire. He wasn't just a source of ideas. He was a thinking partner who helped refine ideas, test logic, identify risks, and maintain discipline. He gave Warren confidence to make bold moves by providing independent validation. And he helped Warren avoid mistakes by pointing out flaws in reasoning or hidden risks. Charlie also played an important public role at Berkshire starting in the 1990s. He began appearing at Berkshire's annual shareholder meetings, sitting on stage next to Warren and answering questions from shareholders. Charlie's answers were often more blunt and philosophical than Warren's. Where Warren would give detailed business analysis, Charlie would cut to the core principle or offer a pithy observation that crystallized the issue. These shareholder meetings became legendary events, with tens of thousands of people traveling to Omaha each year to hear Charlie and Warren discuss business, investing, and life. The meetings were part business update, part investment seminar, part life philosophy course. Charlie's contributions were essential to their appeal. His curmudgeonly wisdom, his literary references, his multidisciplinary insights, and his willingness to say uncomfortable truths made him a folk hero to Berkshire shareholders. Charlie's public statements at these meetings and in interviews revealed his core beliefs. He spoke often about the importance of rationality, but he defined rationality differently than most people. To Charlie, rationality wasn't just logical thinking. It was thinking that accounted for psychological biases, that drew on insights from multiple disciplines, that considered second and third order consequences, and that recognized the limits of knowledge. He spoke about the dangers of envy, resentment, and self-pity, which he called the toxic emotions that destroyed lives. He argued that success came from focusing on what you could control, learning constantly, behaving ethically, and staying within your circle of competence. He warned against getting rich quickly schemes and financial leverage. He emphasized the importance of reputation and the folly of risking it for short-term gains. Charlie also spoke candidly about his mistakes and what he learned from them. He admitted to missing the technology revolution of the late 90s and early 2000s. He acknowledged that Berkshire should have bought more stocks like Google and Amazon when they were younger companies. He reflected on businesses that Berkshire had held too long rather than selling. He talked about the difficulty of selling businesses with good people even when the economics deteriorated. This intellectual honesty was rare among successful investors. Most were reluctant to admit mistakes or learn publicly from failures. Charlie did it freely. He understood that learning required acknowledging errors. Pride and defensiveness were obstacles to growth. By being open about his mistakes, Charlie not only learned from them but also taught others. During the 2000s and 2010s, Charlie remained active as vice chairman of Berkshire even as he aged into his 80s and 90s. His role evolved somewhat as his energy declined, but his strategic thinking remained sharp. He continued to provide counsel on major decisions, attend board meetings, speak at shareholder meetings, and think about Berkshire's long-term future. One of Charlie's major focuses during this period was succession planning. Both he and Warren were aging, and Berkshire needed to prepare for life without them. This was particularly challenging because so much of Berkshire's success depended on their partnership and their capital allocation skills. How do you replace two of the greatest investors and business builders in history? Charlie's approach to succession reflected his systematic thinking. He argued that Berkshire needed to separate the investment function from the operational management function. Running Berkshire's operating businesses required different skills than allocating capital. You needed excellent managers running each business unit. And you needed excellent capital allocators at corporate deciding how to deploy earnings. Berkshire gradually built out this structure. It hired two investment managers, Todd Combs and Ted Westschler, to manage portions of Berkshire's investment portfolio. It developed a deep bench of operating managers running individual businesses. And it planned for Greg Abel, who ran Berkshire's energy business, to eventually become CEO with responsibility for operations while maintaining capital allocation as a board-level function. Charlie supported this structure because it was decentralized, it played to people's strengths, and it could survive the loss of any individual, including himself or Warren. It wasn't perfect. Nobody could truly replace the Charlie and Warren partnership. But it gave Berkshire the best chance of continuing to succeed after they were gone. Charlie also devoted significant time during his later years to other ventures beyond Berkshire. He served as chairman of the Daily Journal Corporation, a small publishing and software company. He used Daily Journal as a vehicle for making investments and for continuing to think about business and capital allocation. The Daily Journal annual meetings became events where Charlie would hold court, answering questions and sharing wisdom with a devoted following. Charlie also became involved in architecture and construction projects. He had strong opinions about building design and was frustrated by what he saw as wasteful practices in the construction industry. He funded several projects including dormitories at the University of Michigan and the University of California, Santa Barbara. These projects were controversial because Charlie insisted on unusual designs that prioritized cost efficiency and space utilization over conventional aesthetics. Critics argued that Charlie's buildings were ugly and that he was imposing his idiosyncratic views on universities. Charlie argued that conventional architecture was wasteful and that his designs provided more value for students at lower cost. The disputes reflected Charlie's contrarian nature. He didn't care what others thought. If his analysis said conventional practice was wrong, he would do it differently regardless of criticism. Charlie's involvement in these projects also reflected something deeper about his character. He was not content to just accumulate wealth. He wanted to apply his thinking to solve problems and create value in multiple domains. Architecture and construction were areas where he saw massive inefficiency. He believed he could do better. Whether he succeeded is debatable. But the attempt was vintage Charlie. Identify a problem, think about it systematically, develop an unconventional solution, and execute regardless of criticism. Throughout his later years, Charlie continued to read voraciously and think across disciplines. He read biography, history, science, and philosophy. He studied cognitive psychology and decision-making. He thought about institutional failure and success. He analyzed why some organizations thrived across generations while others declined. And he tried to extract lessons that could be applied to business and investing. One of Charlie's major intellectual interests was the study of worldly wisdom, which he defined as the ability to make sound judgments across a wide range of situations. He believed that worldly wisdom required a latticework of mental models drawn from multiple disciplines. You couldn't understand the world through the lens of a single discipline. You needed insights from psychology, economics, mathematics, physics, biology, history, and more. Charlie developed a list of key mental models that he believed were essential for sound thinking. These included concepts like compound interest, opportunity cost, marginal analysis, incentives, comparative advantage, creative destruction, network effects, scale economies, tragedy of the commons, prisoner's dilemma, and many others. He argued that if you internalized these models and learned to apply them, you could navigate the world much more effectively than someone who relied on conventional wisdom or narrow expertise. This framework became the foundation for Charlie's approach to problem solving. When faced with a decision, he would consider it from multiple angles using different mental models. What do the economic incentives suggest? What do psychological biases predict? What does history teach about similar situations? What are the probabilistic outcomes? What are the second-order consequences? This multidimensional analysis produced insights that pure financial analysis would miss. Charlie's mental models framework influenced a generation of investors and business people. Books were written about his approach. His speeches on psychology and worldly wisdom were widely circulated. Investment firms adopted checklists and mental models as part of their process. Charlie demonstrated that great investing required more than financial analysis. It required systematic thinking across disciplines. As Charlie aged into his 90s, his physical health declined, but his mental acuity remained remarkable. He continued attending Berkshire's annual meetings and Daily Journal annual meetings. His answers became shorter and sometimes more acerbic, but they remained insightful. He clearly enjoyed these public forums where he could share ideas and engage with people who appreciated serious thinking about business and life. Charlie's relationship with Warren remained close and productive until the end. They still talked regularly. They still consulted on major decisions. They still enjoyed each other's company and intellectual sparring. After nearly 60 years of collaboration, they had developed a shorthand where complex ideas could be communicated efficiently. Each knew how the other thought and could anticipate reactions and concerns. The friendship between Charlie and Warren was remarkable for its longevity and its productivity. Most business partnerships end badly, often due to conflicts over money, credit, or control. Charlie and Warren's partnership thrived because they had complementary skills, mutual respect, aligned values, and no ego conflicts. Warren was comfortable being the public face. Charlie was comfortable being the strategic advisor. Neither needed to dominate or get credit. Both were focused on the work and the results. Charlie passed away on November 28, 2023, just weeks before his 100th birthday. His death marked the end of an era. He had lived through the Great Depression, World War II, the Cold War, the technology revolution, multiple financial crises, and profound social changes. He had witnessed the transformation of investing from a gentleman's pursuit to a professionalized industry. And he had played a central role in that transformation through his partnership with Warren Buffett and his influence on multiple generations of investors. Charlie's legacy extends far beyond his financial success. Yes, he helped build Berkshire Hathaway into one of the most valuable companies in the world. Yes, he generated extraordinary returns for himself and Berkshire's shareholders over many decades. But his more important legacy is intellectual. He demonstrated how multidisciplinary thinking produces better decisions. He showed how temperament matters more than intelligence in investing. He proved that ethical behavior and financial success are not only compatible but reinforcing. And he taught that wisdom requires intellectual humility and constant learning. Charlie's principles and mental models are now taught in business schools. His aphorisms are quoted by investors worldwide. His approach to thinking and decision-making has influenced fields beyond finance. And his example of living a rational, ethical, intellectually engaged life continues to inspire people who never met him. What made Charlie Munger extraordinary was not any single quality but the combination of qualities that rarely exist together. He had rigorous analytical thinking combined with broad multidisciplinary knowledge. He had strong conviction combined with intellectual humility. He had ambition combined with contentment. He had financial success combined with modest living. He had firm principles combined with pragmatic flexibility. And he had serious purpose combined with irreverent humor. The lessons from Charlie's life extend beyond investing to fundamental questions about how to live well and think clearly. Perhaps the most important lesson is that sustained success in any domain requires playing the long game. Charlie compounded his knowledge over decades. He compounded his capital over decades. He compounded his relationships over decades. He never sought quick wins or shortcuts. He understood that real achievement requires patience, discipline, and time. Another critical lesson is the importance of staying within your circle of competence. Charlie was brilliant and knowledgeable across many domains. But he knew what he truly understood and what he didn't. He passed on opportunities that fell outside his expertise regardless of how attractive they appeared. This discipline prevented costly mistakes that came from overconfidence. Charlie also demonstrated the value of learning from multiple disciplines. Narrow expertise can be limiting. The most valuable insights often come from connecting ideas across fields. Psychology informs economics. Biology informs business strategy. Physics informs thinking about systems and feedback loops. History informs understanding of patterns and cycles. The investor or business person who draws on multiple frameworks has advantages over specialists. Temperament emerged as perhaps Charlie's greatest edge. Intelligence and knowledge were necessary but not sufficient. The critical factor was the ability to remain rational during periods of emotion, to think independently when the crowd was convinced of the opposite, and to maintain conviction in sound analysis even when results were temporarily negative. Charlie had this temperament naturally and also cultivated it through systems and habits. The power of incentives was a constant theme in Charlie's thinking. He understood that people respond to incentives and that organizational outcomes were largely determined by how incentives were structured. Well-designed incentives produced good behavior and results. Misaligned incentives produced dysfunction regardless of talent or good intentions. This insight informed how Berkshire structured compensation, governance, and operations. Charlie also emphasized the importance of reputation and ethical behavior. He argued that your reputation is your most valuable asset and that it takes decades to build but can be destroyed quickly. He believed that ethical behavior was not just morally right but also strategically smart. Cutting corners might produce short-term gains but destroyed trust and relationships that were essential to long-term success. The value of partnership and collaboration was central to Charlie's story. His collaboration with Warren Buffett was extraordinarily productive because they had complementary skills, challenged each other's thinking, and maintained mutual respect. Neither could have achieved as much alone as they did together. This demonstrates that even the most capable individuals benefit from finding partners who make them better. Charlie's life also illustrated the importance of continuous learning. He never stopped reading, thinking, and updating his mental models. He was willing to change his mind when evidence contradicted his beliefs. He learned from his mistakes and incorporated those lessons into his framework. This intellectual flexibility and hunger for growth kept him relevant and effective into his 90s. Perhaps most importantly, Charlie demonstrated that a rational, ethical, intellectually serious life can be deeply fulfilling. He found joy in ideas, in solving problems, in building businesses, in teaching others, and in long-term relationships. He didn't need luxury or status or public acclaim to be satisfied. He found meaning in the work itself and in doing it well. Charlie Munger's story is ultimately about the power of clear thinking, patient capital allocation, ethical behavior, and lifelong learning. These principles produced extraordinary financial results. But more importantly, they produced a life well lived. Charlie remained intellectually engaged, maintained close relationships, contributed value to society, and found satisfaction in his work until the very end. That is success by any measure. The investing world lost one of its greatest thinkers with Charlie's passing. But his ideas, principles, and example continue to influence how people think about business, investing, and decision-making. His mental models framework is taught to students. His speeches are still studied. His partnership with Warren Buffett remains the gold standard for collaborative success. And his life demonstrates what is possible when intelligence, discipline, curiosity, and integrity are combined over decades. For anyone seeking to understand how great investors think and operate, Charlie Munger's story provides the blueprint. It's not about secrets or tricks or shortcuts. It's about developing a multidisciplinary framework for thinking clearly about complex problems. It's about staying within your competence and being patient for the right opportunities. It's about maintaining temperament and rationality during periods of extreme emotion. It's about building relationships with people who make you better. It's about behaving ethically and building reputation over decades. And it's about playing the long game, compounding knowledge and capital slowly and steadily over time. This is the essence of Charlie Munger. Not just what he accomplished, but how he thought, how he lived, and what he taught through example. His legacy will endure because these principles are timeless. They worked in the 20th century. They work today. And they will work in the future for anyone willing to embrace them with the same discipline and patience that Charlie did throughout his remarkable life. Charlie's influence on Warren Buffett deserves deeper examination because it fundamentally reshaped one of the greatest investment careers in history. When they met in 1959, Warren was already successful following Benjamin Graham's approach of buying statistically cheap stocks. He would find companies trading below their net working capital, buy them, wait for the price to rise, and sell. It was systematic, it worked, but it had limitations. Charlie challenged this approach from the beginning. He argued that Graham's method was becoming less effective as markets became more efficient. The obvious bargains were disappearing. More importantly, Graham's approach meant you were constantly selling your winners and looking for new ideas. You paid taxes on gains. You lost the compounding that occurred in truly great businesses. And you spent enormous time and energy churning through mediocre opportunities. Charlie proposed a different framework. Find exceptional businesses with durable competitive advantages. Pay fair prices for them. Hold them for decades. Let the earnings compound tax-free within your holding structure. This approach required different skills. You needed to identify what made a business truly great. You needed to evaluate management quality since you'd be partnering with them long-term. You needed to think about what competitive advantages would endure over decades. And you needed patience to let the compounding work. Warren was initially skeptical. Graham's approach had made him wealthy. The idea of paying premium valuations for businesses seemed risky. What if you were wrong about the quality? What if the advantages eroded? What if management deteriorated? The margin of safety that Graham emphasized came from buying assets cheaply. How could you have a margin of safety when paying full or premium prices? Charlie's answer was that the margin of safety came from the durability of the business advantages. If a company had a strong brand that customers loved, that was a margin of safety. If a company had network effects where the value increased as more people used it, that was a margin of safety. If a company had switching costs that locked in customers, that was a margin of safety. These qualitative factors provided protection just as statistical cheapness did, and they had the advantage of compounding over time. The See's Candies investment in 1972 was the case study that convinced Warren. Berkshire and Blue Chip Stamps jointly paid $25 million for See's. By Graham's standards, this was expensive. The company had only $8 million in tangible assets. They were paying more than 3 times book value. Graham would have rejected this deal immediately. But Charlie saw the qualitative factors. See's had a beloved brand in California. Customers associated See's candy with holidays, celebrations, and gifts. They were willing to pay premium prices. The business required almost no capital to operate. The factories and retail stores were paid for. The company generated cash that could be redeployed. And most critically, See's had pricing power. They could raise prices regularly and customers kept buying. This pricing power was transformative. Most businesses can't raise prices without losing customers. They're stuck in competitive industries where price is the main differentiator. But See's could raise prices by 5 or 10% annually and customers barely noticed. This meant that See's earnings would grow with inflation automatically, without any real growth in unit volume. Over the next 50 years, See's proved Charlie's thesis spectacularly. The company generated over $2 billion in pre-tax earnings for Berkshire. It required minimal capital investment over those decades. The $25 million investment returned more than 80 times through cumulative cash flow, not through selling the business. And Berkshire used that cash to make other investments that compounded further. This success fundamentally changed how Warren thought about investing. He began to focus on business quality. He looked for companies with strong brands, pricing power, high returns on capital, and minimal capital requirements. He became willing to pay fair or even premium valuations for truly exceptional businesses. And he shifted from a high turnover approach to a buy and hold forever approach. The transformation wasn't instant. Warren still made Graham-style investments throughout the 1970s. But gradually, the portfolio shifted toward quality. The investments in Coca-Cola, American Express, and other franchise businesses reflected Charlie's influence. By the 1990s, Warren had fully embraced the quality approach. He would later say that meeting Charlie was one of the luckiest moments of his life because it saved him from a lifetime of mediocre returns from mediocre businesses. But Charlie's influence went beyond investment strategy. He also shaped how Warren thought about business operations and organizational structure. Charlie had strong views about incentives, culture, and management. He believed that how you structured an organization largely determined what happened within it. Get the structure right and good outcomes followed naturally. Get it wrong and even talented people would produce poor results. Berkshire's organizational structure reflected Charlie's thinking. The corporate headquarters was kept intentionally tiny. Warren and Charlie believed that large corporate staffs created bureaucracy, politics, and waste. They wanted operating businesses to run independently with minimal interference. So Berkshire's headquarters had fewer than 30 people managing a company with hundreds of thousands of employees and hundreds of billions in revenue. This structure meant that operating companies kept their own cultures and management teams after being acquired by Berkshire. There was no attempt to impose corporate policies or integrate operations. Each business ran as it had before, reporting financial results but making its own decisions. This autonomy attracted exceptional managers who valued independence and wanted to build businesses without corporate interference. Charlie also influenced how Berkshire thought about compensation and incentives. He argued that compensation should be tied to metrics that management could actually control and that mattered for long-term value creation. Stock options, which were popular at many companies, made little sense to Charlie. They rewarded management for stock price increases that might have nothing to do with business performance. They encouraged short-term thinking. And they diluted shareholders. Instead, Berkshire paid managers based on the specific metrics that mattered for their business. A retailer might be paid based on same-store sales growth and return on capital. An insurance company manager might be paid based on underwriting profit and growth in float. A utility manager might be paid based on regulatory outcomes and capital project returns. Each compensation plan was tailored to align management's interests with long-term business value. This approach to compensation was unusual in corporate America. Most companies used standard formulas and stock option packages. Charlie thought this was lazy and counterproductive. He believed that carefully designed incentives specific to each situation produced better results. The evidence supported him. Berkshire's operating companies generally outperformed competitors, and managers stayed for decades rather than job hopping. Charlie also shaped Berkshire's acquisition strategy. He insisted that Berkshire should never make hostile acquisitions. The reasoning was that hostile deals poisoned relationships with management. If you force someone to sell their company against their will, they would resent you and likely leave or become uncooperative. Since Berkshire's model depended on keeping existing management in place, hostile deals made no sense. This principle limited Berkshire's opportunities but also created advantages. Sellers knew that Berkshire would treat them fairly, keep its word, and let them continue running their businesses. This reputation meant that family business owners who wanted to sell often came to Berkshire first. They valued the certainty of the deal closing and the knowledge that their business legacy would be preserved. Charlie's ethical principles also influenced Berkshire's behavior in ways that created competitive advantages. He insisted on complete honesty in dealings with shareholders, regulators, customers, and partners. He argued that deception might work in the short term but destroyed trust and reputation over time. And reputation was Berkshire's most valuable asset. This commitment to honesty showed up in many ways. Berkshire's annual reports were remarkably transparent, discussing mistakes and problems openly. Warren and Charlie answered shareholder questions directly even when the answers were unflattering. When Berkshire made mistakes, they acknowledged them publicly. When they didn't know something, they said so rather than bluffing. This transparency built trust with shareholders and created a stable shareholder base. Most of Berkshire's shares were held by long-term investors who trusted Warren and Charlie's judgment. This meant Berkshire didn't face pressure for short-term earnings management or quarterly guidance. Warren and Charlie could make decisions based on long-term value creation without worrying about next quarter's stock price. Charlie's multidisciplinary thinking also influenced specific investment decisions throughout Berkshire's history. When Berkshire considered buying insurance companies, Charlie thought about the decision through multiple lenses. From a financial perspective, What were the underwriting economics and the quality of the float? From a psychology perspective, what were the behavioral patterns of claim adjusters and how could they be incentivized properly? From a mathematics perspective, what were the probability distributions of large losses and how should reserves be calculated? From a history perspective, what did past insurance crises teach about what separated survivors from casualties? This multidimensional analysis produced insights that pure financial analysis would miss. Charlie could identify risks that weren't apparent in the historical numbers. He could recognize patterns in management behavior that predicted future problems. He could see structural advantages that would compound over time. And he could evaluate whether Berkshire had the capabilities to operate successfully in a particular industry. One example was Berkshire's entry into the electric utility business. In the late 1990s and early 2000s, Berkshire built a major position in utilities through Mid-American Energy. Many investors didn't understand why Berkshire was buying utilities. They were slow growth, capital-intensive, heavily regulated businesses. They didn't fit the profile of high-return, capital-light businesses that Berkshire supposedly preferred. But Charlie saw advantages that others missed. Utilities generated predictable cash flows over very long time horizons. They could earn reasonable returns on enormous amounts of capital. They had natural monopolies in their service territories. Regulation actually provided stability by limiting competition. And utilities were investing heavily in renewable energy, which had strong political support and provided opportunities for profitable growth. Most importantly, utilities aligned with Berkshire's permanent capital structure. Berkshire could invest billions of dollars and earn steady returns for decades. The business wasn't exciting, but it deployed capital effectively at scale. And unlike many investors who needed quarterly earnings growth, Berkshire could be patient and think in 30 or 40-year time horizons. Charlie's influence was also apparent in what Berkshire didn't do. Berkshire avoided leverage almost entirely despite the theoretical benefits. Most financial theory suggested that using moderate leverage increased returns. If you could borrow at 5% and invest at 15%, leverage magnified gains. Many successful investors and companies used leverage extensively. But Charlie was adamantly opposed to leverage for Berkshire. He had seen too many smart people destroyed by leverage during market crashes. Leverage meant you could be forced to sell assets at the worst possible time. It meant you lost the flexibility to be opportunistic when others were distressed. It meant you were vulnerable to temporary market dislocations that had nothing to do with your investment's fundamental value. Charlie's view was that leverage was unnecessary and dangerous. If you made good investments and held them long enough, you would become very wealthy without taking leverage risk. Why risk everything for somewhat higher returns when you could achieve extraordinary results with no leverage? The math might favor moderate leverage in theory, but in practice, leverage destroyed more fortunes than it created. This principle saved Berkshire during multiple crises. In 2008, when leveraged investors were forced to sell at fire sale prices, Berkshire had $60 billion in cash. While others were desperate for liquidity, Berkshire could make opportunistic investments in Goldman Sachs, General Electric, and other quality companies at attractive terms. The lack of leverage turned a crisis into Berkshire's greatest opportunity. Charlie also influenced Berkshire's approach to technology investing. Throughout the 1990s and early 2000s, Berkshire was criticized for missing the technology revolution. While investors made fortunes in Microsoft, Intel, Cisco, and later Google, Amazon, and Facebook, Berkshire stuck with businesses like insurance, utilities, and consumer products. Critics said Warren and Charlie were dinosaurs who didn't understand the new economy. Charlie's response was characteristically blunt. He said he and Warren didn't invest in technology because they didn't understand it well enough to evaluate competitive advantages. Technology changed too fast. Today's dominant company could be tomorrow's has been. Network effects and winner-take-all dynamics meant you needed to predict which companies would dominate. Making those predictions required expertise they didn't have. This discipline of staying within their circle of competence meant missing some spectacular opportunities. But it also meant avoiding spectacular failures. For every Microsoft that succeeded, there were dozens of technology companies that disappeared.
Pets.com, Webvan, Cosmo, and countless others had compelling stories but failed catastrophically. By avoiding what they didn't understand, Charlie and Warren avoided these disasters. However, Charlie's thinking on technology evolved over time. By the 2010s, he recognized that some technology companies had developed durable competitive advantages that could be understood with traditional business analysis. Apple wasn't primarily a technology company in Charlie's view. It was a consumer brand with extraordinary customer loyalty, an ecosystem that locked users in, and pricing power. Those were understandable advantages. Similarly, Charlie eventually recognized that companies like Google and Amazon had built durable advantages through network effects, scale economies, and customer habit formation. These advantages could be evaluated using traditional frameworks. The companies were no longer speculative startups but established franchises with proven business models. This intellectual flexibility to update his thinking when evidence changed was classic Charlie. He wasn't rigidly committed to past positions. When technology companies matured and developed characteristics he understood, he was willing to reconsider them. Berkshire ultimately made major investments in Apple and Amazon, generating billions in gains. Charlie's willingness to evolve prevented past mistakes from becoming permanent blind spots. Charlie's role in Berkshire extended beyond strategic advice to specific crisis situations where his judgment proved invaluable. One example was the Salomon Brothers crisis in 1991. Berkshire had invested in Salomon Brothers, a major investment bank, in 1987. The investment was structured as preferred stock with a 9% dividend and warrants to buy common stock. It gave Berkshire a significant stake in one of Wall Street's premier firms. In 1991, a scandal erupted. Salomon Brothers traders had submitted false bids in treasury auctions, violating federal regulations. The fraud was serious. The government was considering criminal charges. Salomon's ability to participate in treasury auctions, a core part of its business, was at risk. The scandal threatened to destroy the firm. Warren became interim chairman to help resolve the crisis. He spent months in New York dealing with regulators, clients, and employees. He testified before Congress. He replaced management. He reformed controls and compliance. It was an enormous time commitment and a high-stakes situation. If Salomon collapsed, Berkshire would lose its investment and Warren's reputation would be damaged. Charlie provided crucial support during this crisis. He helped Warren think through the strategic options. He reinforced the decision to be completely transparent with regulators rather than trying to minimize the problems. He helped evaluate which managers should stay and which should go. And he provided perspective when the situation felt overwhelming. The Salomon crisis was ultimately resolved successfully. The firm survived, though damaged. Berkshire eventually exited the investment at a modest profit. But the real lesson was about crisis management and reputation protection. By being completely honest and cooperative with regulators, Warren and Berkshire enhanced their reputation even though they were associated with a scandal. People saw that Warren did the right thing even when it was difficult and costly. Charlie's influence during this crisis was subtle but important. He helped Warren stay calm and rational during an emotionally charged situation. He provided a sounding board for decisions. And he reinforced the principle that protecting reputation mattered more than protecting the investment. This long-term thinking prevented Warren from making decisions that might have salvaged the Salomon investment but damaged Berkshire's reputation. Another crisis where Charlie's judgment proved valuable was Berkshire's investment in ConocoPhillips in the mid-2000s. In 2005 and 2006, as oil prices were rising toward $140 per barrel, Berkshire invested billions in ConocoPhillips, an oil company. The investment thesis was that oil prices would remain high and ConocoPhillips was undervalued relative to its reserves and production. But oil prices crashed in 2008, falling from $140 to $35 per barrel. Berkshire's ConocoPhillips investment lost billions. Warren acknowledged it was a major mistake. He had bought an oil company at peak prices based on faulty assumptions about commodity prices. It was exactly the kind of error Graham had warned about, paying too much at the top of a cycle. Charlie's role was to help Warren analyze what went wrong and extract lessons.
The core mistake was trying to predict commodity prices, which was outside their circle of competence. They understood businesses with durable competitive advantages. They didn't understand global oil markets with complex geopolitical and economic drivers. By venturing outside their expertise, they made a costly error. The lesson reinforced a core principle. Stay within your circle of competence. The attractiveness of an opportunity is irrelevant if you don't have the knowledge to evaluate it properly. Better to pass on opportunities outside your expertise than to make large mistakes in areas you don't understand. This lesson would prevent similar errors in the future. Charlie's thinking about mistakes and learning was sophisticated. He didn't view mistakes as moral failures or sources of shame. He viewed them as inevitable parts of the learning process. Everyone makes mistakes. What separates successful people from unsuccessful people is how they respond to mistakes. Successful people acknowledge them, analyze them, extract lessons, and modify their approach. Unsuccessful people deny them, rationalize them, or repeat them. This attitude toward mistakes created a culture at Berkshire where honest error analysis was valued. When investments went wrong, there was no finger-pointing or blame. Instead, there was systematic analysis of what happened and why. This learning orientation helped Berkshire improve over time and avoid repeating errors. Charlie also thought carefully about the role of luck in success. He acknowledged that he and Warren had been extraordinarily lucky in many ways. They were born in America in the 20th century, giving them access to education and opportunity. They lived during a period of tremendous economic growth. They entered investing when competition was less intense than it later became. They had good health and long careers, allowing decades of compounding. But Charlie distinguished between luck and its proper exploitation. Everyone experiences both good and bad luck. What matters is how you respond. When you get lucky, do you squander the opportunity or capitalize on it? When you get unlucky, do you give up or persist? Success requires both catching good luck and making the most of it. Charlie and Warren caught many lucky breaks. Warren got to study with Ben Graham. Charlie met Warren at a crucial moment. Berkshire acquired insurance companies that provided permanent capital. They operated during a period when markets were less efficient. But they also worked incredibly hard, thought deeply, maintained discipline, and played the long game. The luck mattered, but so did their response to it. This perspective on luck kept Charlie humble despite extraordinary success. He never believed he was smarter than everyone else or that his success proved his superiority. He recognized that different circumstances could have produced different outcomes. This humility made him open to learning and willing to acknowledge when he was wrong. As Charlie aged into his 80s and 90s, his public role at Berkshire became increasingly important. His appearance at annual shareholder meetings was a major draw. Thousands of people wanted to hear his wisdom. His answers were often shorter and more pointed than Warren's detailed explanations. Where Warren would walk through analysis step by step, Charlie would cut to the essence in a few sentences. Some of Charlie's most memorable statements came during these later years. When asked about cryptocurrency, he called it rat poison squared, arguing that it was speculation without economic value. When asked about political divisiveness, he lamented the loss of civility and shared purpose. When asked about success, he emphasized rationality, patience, and continuous learning. When asked about life, he stressed the importance of deserving what you want rather than just wanting it. These pithy statements concealed deep thinking. Charlie's ability to distill complex issues to their essence came from decades of study and reflection. He had thought about these questions from multiple angles. He had read extensively. He had experienced success and failure. He could see patterns that others missed because he had a broader knowledge base and longer time horizon. Charlie's relationship with wealth was also instructive. Despite being a billionaire, he lived modestly. He continued living in the same house he had owned for decades. He didn't own a yacht or private island. He didn't collect art or cars. He didn't seek luxury or display. His expenses were a tiny fraction of his wealth. This frugality wasn't about being cheap. Charlie spent money on things he valued. He was generous with family, friends, and causes he supported. He funded building projects. He supported educational institutions. But he didn't spend on things that didn't provide real value to him. Status consumption held no appeal. He knew who he was and didn't need external validation. This approach to money reflected Charlie's deeper philosophy. Money was a tool for independence and opportunity, not an end in itself. Once you had enough to be comfortable and secure, additional money mattered less. What mattered was how you spent your time, who you spent it with, what problems you worked on, and whether you were learning and growing. Charlie found satisfaction in intellectual work. He loved analyzing businesses, solving problems, and thinking about complex questions. He enjoyed teaching and sharing ideas. He valued long-term relationships with people he respected. These sources of satisfaction didn't require vast wealth. They required curiosity, discipline, and engagement. Charlie had those qualities throughout his life. The partnership between Charlie and Warren lasted nearly 60 years, from 1959 until Charlie's death in 2023. This extraordinary longevity is rare in business partnerships. Most partnerships end in conflict over money, credit, or control. The fact that Charlie and Warren maintained a productive collaboration for 6 decades says something profound about both men and their relationship. Several factors enabled this longevity. First, they had complementary rather than competitive skills. Warren was better at some things, Charlie at others. Neither felt threatened by the other's strengths. Second, they had aligned values around integrity, long-term thinking, and rational analysis. There were no fundamental conflicts about how to operate. Third, they genuinely liked each other and enjoyed working together. The partnership was not just professionally valuable but personally satisfying. Fourth, neither had a large ego requiring constant validation. Warren was the public face of Berkshire and got most of the credit. Charlie could have resented this. But he didn't need public recognition. He was satisfied with the intellectual work and the results. Warren, for his part, consistently credited Charlie's influence and made clear that the success was joint. Fifth, they had established clear roles that avoided conflict. Warren was CEO and made final decisions. Charlie was vice chairman and strategic advisor. This structure prevented power struggles while allowing Charlie's influence to be felt on major decisions. Both were comfortable with the arrangement. The depth of their intellectual partnership is evident in how they finished each other's thoughts and built on each other's ideas. At shareholder meetings, Warren would start explaining something and Charlie would add the punchline. Charlie would raise a concern and Warren would address it. They had discussed the issues so thoroughly over so many years that they shared mental models and frameworks. This partnership produced better results than either could have achieved alone. Warren's gift for analyzing financial statements and calculating intrinsic value was enhanced by Charlie's multidisciplinary framework and quality focus. Charlie's strategic thinking was enhanced by Warren's encyclopedic knowledge of businesses and industries. Together they covered more ground and saw more angles than either could have individually. The partnership also provided mutual support during difficult periods. When Warren faced the Salomon Brothers crisis, Charlie provided perspective and advice. When Charlie dealt with personal challenges, Warren was supportive. When either questioned a decision or felt uncertain, the other provided reassurance or pushback as needed. This mutual support helped both navigate challenges that might have been overwhelming alone. Perhaps most valuable, they kept each other rational and prevented mistakes. Warren's optimism was balanced by Charlie's skepticism. Charlie's contrarian instincts were balanced by Warren's practical business sense. When either was getting too confident or too pessimistic, the other provided correction. This mutual accountability prevented emotional decision-making and kept both grounded. The intellectual legacy that Charlie and Warren leave extends beyond Berkshire's financial success. They demonstrated that rational, ethical, long-term oriented business building could produce extraordinary results. They showed that transparent communication with shareholders created loyalty and stability. They proved that decentralized operations with strong incentives outperformed centralized bureaucracies. and they illustrated how multidisciplinary thinking produced insights that narrow expertise missed. These lessons have influenced business practice globally. The focus on business quality and competitive advantages is now standard in value investing. The emphasis on management integrity and shareholder alignment has shaped corporate governance. The use of checklists and mental models has spread to multiple fields. And the demonstration that ethical behavior and financial success are compatible has provided a counterexample to the cynical view that business requires moral compromise.